Okay, let's jump right into this explainer and demystify the massive, globe-spanning machine that is our financial system. Look, whether you're actively day trading or just passively saving for retirement, understanding the actual underlying mechanics of this system is absolutely fundamental.
Here's our roadmap for today. We're going to cover the purpose of the financial system, how we classify assets and markets, the role of financial intermediaries, how to navigate positions and leverage, executing trades and orders, and finally, the anatomy of well-functioning markets.
So let's start with part one, the actual purpose of the financial system, or the engine's main goal.
The system really boils down to facilitating some highly specific goals: saving for the future, borrowing for right now, raising equity capital, managing risks, exchanging assets on the spot, and trading on information. Ultimately, this financial engine does something pretty incredible. It matches absolute strangers. It pairs someone with surplus capital to someone who needs a loan, or someone holding a ton of risk to someone willing to actually bear it. Moving on to part two, let's look at classifying assets and markets, the materials and gears inside the machine.
Traders basically categorize these gears into distinct classes, separating financial assets from physical assets. So, financial assets include securities, your classic debt and equities, as well as currencies and derivative contracts. Physical assets, on the other hand, are your tangible commodities and real assets, like gold or real estate, and each one of these plays a highly specific role in helping market participants hit their financial targets.
Now you've got to pay attention to how the money flows here. Primary markets are where brand new assets are born, and the funds flow directly to the issuer. Think of a company going public to raise capital. But the secondary market is just as crucial. That's where existing assets are simply traded between investors. Why is that important? Well, because it provides the liquidity that makes investors willing to buy those primary market assets in the first place.
All right, part three. Let's talk about the role of financial intermediaries, the mechanics of the system.
Whether it's a depository institution like a bank lending out funds, an insurance company pooling risks, or even securitizers and arbitrageurs processing trades, intermediaries solve a really expensive problem: finding a trustworthy counterparty. Without them, you'd literally have to personally track down a stranger willing to lend you the exact amount of cash you need exactly when you need it, and just trust that they won't default. Intermediaries step right into the middle, managing that credit quality and risk so you simply don't have to.
A great way to think about this is the difference between brokers and dealers. A broker basically acts like a real estate agent. They arrange trades and find you a buyer. A dealer, though, they act more like a used car lot. They'll buy your asset directly to keep their own inventory stocked and provide liquidity over time. They risk their own capital to make sure you can sell, even if another buyer hasn't shown up at the market yet.
Let's shift gears to part four, navigating positions and leverage, or what I like to call the operator's levers. Market positions can get highly complex. For instance, a long position on a put option actually gives you short exposure to the underlying instrument's risk. Normally, when you own a regular asset, you have a long position. You win if prices go up. But because a put option gives you the right to sell an asset at a set price, you actually benefit if the underlying asset's price tanks. It's a pretty fascinating layer of indirect exposure, right?
Now, if you want to profit directly from a price drop, you'd use a short position. You borrow securities, sell them, and hope to buy them back cheaper later. But watch out, because the potential losses here are unbounded if the price skyrockets instead. Think about it. The maximum loss on a regular long position is 100%. But if you short a stock at $20 and it surges to $1,500, your losses just keep multiplying infinitely as that price climbs.
Which brings us to a really powerful yet incredibly dangerous lever in the financial machine: leverage. Traders often want to punch way above their weight class by borrowing money from their brokers to buy more securities. We call this buying on margin.
Let's break down the math. If your margin requirement is 40%, your maximum leverage ratio is 2.5. That means both your gains and your losses are mathematically multiplied 2.5 times. Your position is 2.5 times larger than your actual equity. So a 10% drop in the stock price, that doesn't mean a 10% loss for you. It means a massive 25% wipeout of your equity.
And when you buy securities on margin and the price drops significantly, you trigger what's called a margin call. This forces you to inject cash immediately or face having your position totally liquidated by your broker. Trust me, the broker is not going to sit around waiting for you to go bankrupt. They will ruthlessly close out your position to protect the margin loan they gave you.
Okay, moving on to part 5, executing trades and orders. Time to look at the control panel.
When you're routing orders in secondary markets, you have to choose your execution and validity instructions. A market order prioritizes immediate execution at the best available price. A limit order, however, strictly controls the price, but you sacrifice the certainty that the trade will actually execute. And the environment matters too. Quote-driven markets rely on dealers for liquidity, order-driven markets let traders supply liquidity to each other, and brokered markets actively hunt down hidden buyers and sellers. Knowing exactly which market structure you're in dictates how quickly and efficiently your order gets filled.
Finally, Part 6, the anatomy of well-functioning markets. Let's evaluate the health of the whole machine.
A genuinely healthy financial system has to have complete, low-cost markets where prices accurately reflect all available information. If the costs of arranging trades are low, the system is operationally efficient. If timely financial disclosures ensure prices are accurate, it's informationally efficient. And crucially, the main objective of market regulation is to protect these exact efficiencies, preventing fraud and ensuring fairness, so capital gets allocated to its absolute best uses.
So I'm going to leave you with this provocative thought. Could our modern global economy even exist without a system that allows absolute strangers to safely move money through time and hedge against the unknown? Understanding the gears of this blueprint is your very first step to mastering the world of investing, because the financial system isn't just numbers on a screen, it's the foundation of global progress. Thanks for diving into this explainer with me, and I'll catch you next time.